Have you ever heard someone say that banks just create money out of thin air? That when you walk into a bank to borrow for a car, a house, or a business, they don't actually pull that money out of a vault filled with gold or stacks of cash. They just type a few numbers into a computer and voila, new money exists. That idea sounds almost unbelievable, almost like a conspiracy theory, but it's actually true. When banks issue loans, they create deposits at the same time, and that raises a fascinating question. If banks can create money digitally whenever they issue loans, then why do they care so much about your deposits? Why do they still compete to attract saving, checking accounts, and term deposits if supposedly they can just create new money whenever they want? This question strikes at the heart of how modern banking works, and the answer reveals something deeper. Yes, banks can create money in the form of deposits, but that doesn't mean deposits are irrelevant or worthless. In fact, deposits are one of the most valuable resources a bank can have. To understand why, we need to go step by step. Let's begin with the money creation process itself. Imagine you go into a bank and ask for a loan of $10,000 to buy a car. If the bank approves the loan, they don't hand you someone else's saving. What happens on their balance sheet is simple but powerful. On the asset side, they record loan to customer, $10,000. On the liability side, they create a deposit for you, also $10,000. You see the deposit in your checking account and you can go spend it on your car. At that moment, the bank has created brand new money that didn't exist before. Economists call this process credit creation, and it's why private banks play such a central role in the money supply. But here's the catch. Just because the bank can create a deposit for you doesn't mean they can ignore everything else. Once you spend that $10,000, maybe by wiring it to a car dealer who banks with another institution, your bank suddenly has to transfer funds to that other bank. And that transfer doesn't happen with made-up deposits. It requires central bank reserves, the special kind of money that only banks can hold in accounts at the central bank. If your bank doesn't have enough reserves to settle the payment, they're in trouble. So one big reason banks still care about deposits is that they provide a more stable base of funding that helps manage these flows of payments between institutions. Think of it like this. You can create an IOU to your friend, saying, "I'll pay you later." Writing that IOU doesn't cost you anything, but the moment your friend wants to cash it out, you actually have to come up with money. For banks, the loan and deposit they create is like writing an IOU. When customers move that money around the system, the bank has to settle up. Deposits that remain with the bank give it breathing room. Without them, the bank would constantly have to scramble for reserves in the interbank market or borrow from the central bank, which is more expensive and riskier. There's also the question of liquidity. Imagine you're a bank manager. You know people withdraw cash, pay bills, and move money to other banks every day. If all your funding came from wholesale borrowing, say issuing bonds or borrowing in money markets, you'd constantly be exposed to swings in market rates and investor sentiment. One day, it might be easy and cheap to borrow. The next day, if markets panic, you might not be able to borrow at all, or you might have to pay sky-high interest. That's not a stable way to run a business. Deposits, on the other hand, especially retail deposits from ordinary customers, tend to be sticky. People don't usually pull out all their money overnight. Their paychecks come in, bills go out, but balances remain relatively stable. That stability makes deposits a prized source of funding. Another layer is profitability. Banks make money on the spread between what they earn on assets, like loans, and what they pay on liabilities, like deposits. Wholesale funding, such as borrowing from other banks or issuing short-term debt, usually comes with higher interest costs. Retail deposits, especially checking accounts, often pay little or no interest. That means they're cheap funding. If you're a bank, would you rather fund your lending with deposits that cost you, say, 0.5% in interest, or market borrowing that costs you 2%? Clearly, deposits are better for your bottom line. This is why banks advertise savings accounts and offer perks for deposits. It's not because they can't technically create money without them. It's because deposits give them a cheaper, more reliable foundation for lending. Now let's add regulations into the picture. Modern banks operate under strict rules about capital and liquidity. When a bank makes a loan, it increases its risk-weighted assets, and regulators require the bank to hold a certain percentage of capital against those assets. Capital usually means shareholders' equity, not deposits. But on the liquidity side, regulators also demand that banks maintain a certain amount of stable funding compared to their assets. This is where deposits shine. Regulators view retail deposits as more stable than wholesale borrowing. So, to meet liquidity coverage ratios and net stable funding ratios, banks actively seek deposits. Without them, they'd fail regulatory tests and could be forced to shrink their lending. Let's bring this back to the everyday experience. When you see a bank offering a slightly higher interest rate on a savings account or launching a new kind of deposit product, they're not doing it just to be nice to customers. They're competing for that stable, cheap funding base that allows them to make more loans profitably, to manage liquidity smoothly, and to stay on the good side of regulators. Even though they can create deposits when they lend, they still need deposits that actually stick around, that don't flee at the first sign of stress, and that balance the flow of money in and out of their institution. There's also a reputational factor. Imagine two banks. One has millions of customer deposits, a wide base of retail savers, and steady inflows from households and businesses. The other relies heavily on borrowing from markets and has very few retail customers. Which bank seems more trustworthy, more embedded in the community, more stable in a crisis? Most people would pick the first one. Deposits aren't just about numbers on a balance sheet. They also represent relationships, customer loyalty, and public confidence. That confidence can matter hugely when times get rough. Let's revisit the paradox directly. People often say, if banks can just create money, why do they want mine? The short answer is, creating deposits through lending is only the first step. After that, the bank has to manage liquidity, settlements, capital requirements, regulatory metrics, profitability, and customer trust. Deposits solve problems in all of those areas. Without deposits, a bank's balance sheet might look fine on paper, but in practice it would face constant stress. With deposits, the bank can expand lending more safely, more cheaply, and more sustainably. To make this more concrete, picture a scenario. A bank makes a new loan of $100,000. Instantly, the customer's deposit account shows that balance. The customer then wires $50,000 to a contractor who banks elsewhere. That means $50,000 leaves the original bank and has to be settled in reserves. If the bank has ample deposits, that outflow is just a blip. They still have plenty of stable funding. If they lack deposits, they might suddenly need to borrow reserves on the interbank market or even from the central bank, paying high rates. That difference directly affects profitability and stability. So while the loan created a deposit, the deposit doesn't necessarily stay. Attracting deposits from the public helps balance these flows. And let's not forget the psychological side. For centuries, banks have built their legitimacy on the idea of safekeeping people's money. Even in an era of digital money creation, that narrative still matters. If people stopped depositing altogether, if they only saw banks as loan machines that conjure numbers from nowhere, public trust might erode. Deposits anchor the social contract between banks and their customers. So the next time you hear someone say, banks don't need your money because they create money themselves, you'll know the deeper truth. Yes, banks can create deposits when they make loans, but deposits from customers remain central. They keep banks liquid, profitable, and compliant with regulations. They serve as cheap funding, they stabilize the system, and they embody the relationship between banks and the communities they serve. Without deposits, the magical process of money creation would quickly run into very real constraints. In the end, it's a both-and situation. Banks create money, and they need deposits. Those two truths aren't contradictory, they're complementary. Deposits are not the raw material for lending in the simplistic sense many people think, but they are the glue that holds the system together after loans are made. And that's why your bank still cares so much about your paycheck, your saving, and your deposits, even in the digital age.